Let's make a bold prediction about the Singapore market in the upcoming 1 to 3 years. The decisions you make in the next 6 months will decide whether you are on track in terms of your wealth property journey or get stuck watching while others make money and your property stays stagnant. Most people, even these so-called experts, are still looking at property prices and comparing them to last year or during the COVID period. But the truth is, the next 3 years will look very different. So in this video, I'll break down what's really going on in the current market, what's coming up next, and how can you stay ahead of the curve. So let's dive in today. Before we talk about where the market's going, let's talk about where the current market is. So private property prices are still up, HDB prices are still climbing, they're still hitting record prices, and at the same time, transaction volumes have actually dropped a bit compared to last year. So now on the surface, it looks like the market is still going strong. However, when we dig deeper, there's a lot more fragmentation than ever. So right now, I'm seeing and what I'm sharing with my clients are 3 main different mini segment markets or mini markets that are actually forming. So first is the luxury market, your 5 mil and above properties. These are still holding up well even with the cooling measures. Second, the mass market segment. So we're talking about 1.5 mil properties all the way to your 3 mil properties. These are starting to show a bit of signs of price sensitivity. And then of course we have the HDB resale market, which is generally still strong, there's still demand for it, but we're noticing a bit more hesitation from the buyers, especially with the influx of a lot of supply from the government. So there's no longer one clear trend. Different markets are actually moving differently. So this is what makes today's market very, very different from maybe, for example, the last time we saw a huge adjustment was during the COVID period. During circuit breaker, it was more of a demand shock. People weren't buying because of uncertainty. Interest rates were low, construction was delayed but still going on, and the government pumped in a lot of support into the market. Today, however, it's slightly different. I would say we're facing a triple challenge. First, your interest rates have actually gone up compared to during the circuit breaker that period. So that's putting a lot of pressure on affordability. Second, your supply chains are still recovering. Third, of course, most important, we have the US tariff issues. So the cost of construction materials has actually gone up, developer margins are squeezed, and launches are getting a bit more selective. So back then when liquidity was everywhere, now global economy is tightening. So slightly different kind of markets. If you're making decisions based on the COVID era conditions, you might be walking into the market blind. Next off, let's talk about tariffs. Most people think tariffs, that's just a US-China thing, nothing to do with us, right? Singapore market, the government has come out to say Singapore market will be affected. In the near future, developers will be facing rising costs because of raw materials like steel, cement, all of these are becoming more expensive. Moving forward, costs definitely will move up. So when that happens, developers tend to do a few things. First, launch fewer projects or delay them. Price their launches higher to protect margins. That's assuming that the market will buy into this kind of prices. And third, cut corners, which none of us want. Honestly, in Singapore's market, option 3 is not likely going to happen in Singapore because of our stringent checks by government as well. So this means in the upcoming couple of years, we might actually see less supply coming to the market. And when good units are actually launched, demand gets even more concentrated, okay? So if you think prices will drop just because volumes are actually slowing down, you really have to be a bit careful there. So the supply crunch might actually flip the narrative. So now let's look at what really matters in the next 1 to 3 years. Forget the usual index stats. What I'm actually tracking are 5 to 6 main things. First off, new launch pipeline. This is one of the lowest in the last few years. Second, our interest rate spreads, a fixed versus our floating, is still a hot topic. Number 3, income to mortgage ratio, affordability is getting tighter. Number 4, unsold developer stock. If it dips below a certain safe level, prices rises. Number 5, GDP growth, because everything still ties back to the economy. However, the key stat I'm actually watching, the absorption rate, how fast new projects sell. So if a launch moves more than about, I would say 30% on launch weekend, despite higher interest rates, that tells you that the demand is generally still strong. So with the recent launch of One Marina Gardens, we saw it was actually sold 38% on launch day, which gives us an indication, the market is still generally strong. There are still strong fundamentals in the market. So that's not exactly a sign of weakness. So based on everything that we're seeing, I would say here are the 3 possible outcomes over the next 1 to 3 years. First off, scenario 1, the soft landing. So to me, this is a most likely scenario. I would say maybe at least 60% chance of this happening. So in this scenario, my prediction is that prices will go up maybe about 2-3% all the way to maybe about 5% per year over the next few years. Transaction volume picks up. The new launches still stay about 10 to 15% at least above the resale prices. In the second scenario, it'll be more of a plateau situation. To me, this will be maybe about 30% chance of this happening. Interest rates stay high for a longer period of time. Prices stagnate, growth is really slow. You have fewer transactions in the market as well, and developers pull back in terms of buying new land. So in scenario 3, the correction, I would give this scenario maybe about 10% chance of happening. First, global recession has to hit us. Prices dip maybe about 5 to 10%, foreign demand falls even more, and the government might actually ease up some of these cooling measures. I personally think that the soft landing is the most likely of all the 3 scenarios. However, for my investors and for my clients, we have to prep for all 3 scenarios. Next up, what should we do in each scenario? So the real question isn't what will happen. The more important question should be what will I do in each scenario. So to me, if you're a homeowner looking to upgrade, in the soft landing scenario, essentially you need to move up before prices pick up. Focus on projects with tight supply. If the market is going to plateau, you need to secure your next home first, then sell, so you avoid being stuck in a limbo. In a correction scenario, you need to hold your cash. You'll have chances to buy below valuation. Second group of clients, if you're an investor yourself, in the soft landing scenario, I would suggest look at growth areas with limited new supply. Price premiums are worth it in those areas. In a plateau kind of market, focus on yield, focus on positive cash flow properties that give you a buffer. If we go into a correction scenario, what should we be looking at? Be ready to swap in. Essentially, developers with unsold stock may give even more discounts, and you can find even better buys in those kind of markets. And last but not least, if you're a developer in the industry, to me, it's always prepare to shift strategies very quickly. So in a soft landing approach, launch fast. In a correction market, bank land, wait for the rebound if it's possible. So here's the biggest lesson from COVID. The winners didn't buy because they timed the bottom perfectly. I always tell my clients there's no crystal ball that can tell you when it's going to be the bottom of the market, when it's going to be top of the market. Essentially, these people won because they understood the difference between temporary fear and long-term fundamentals. We saw clients during the circuit breaker hold their properties for 3-4 years, walk away with 6-digit figures. Same thing now. Yes, prices might go up, might go down, or stay flat in the short term, but we need to understand what happens in the long term. So fast forward 3 years, 4 years, will you look back and regret not making a move? Because whether it's a soft landing, it's a plateau, it's a correction, most important in the long term, property in Singapore still remains one of the most powerful ways to build wealth. So where does that leave you? Do you know exactly what to do if the rates go down, go up, or even plateau? If not, it's like navigating without a map. So what I always share with my clients is that you need to understand the market as a whole, then you can make your move properly in your property journey. So what I suggest, download my Singapore property market scenario planning guide. The link is in the description below. Second, book property strategy session with me. We'll go through your current situation, break down all 3 scenarios, and map out your next best move. I only do a few sessions a month, so if you're serious about taking control of your property journey, click below and let's plan properly. And remember, clarity beats timing every single time. Thanks for watching. Hit subscribe if you found this useful so that you can be notified about our upcoming videos as well. See you soon!